All right, welcome back to another episode of Trades Talk. We're here today with Justin and Maggie. Justin's back from his adventures in the Hawaiian Islands. Justin, how was it?
Aloha. It was fun. I got a nice tan. My sister got married, which is super special. And it was just a great time to disconnect and recharge the batteries. I'm excited for this one. This episode was a lot of fun. I'm excited to dive in and talk a little bit of finance with our group, which we haven't had too many finance guests on.
No, we haven't. And so today's episode's guest is Scott Crawford. And Scott is he's a partner in Preferred CFO. And his main role is helping businesses determine if and when they need a CFO partner, what that partnership looks like, when to bring it in house. He talks a lot about gap principles, which we learned something about today. But ultimately, the conversation is really focused on what are businesses supposed to be looking at, what really determines what makes a good CFO.
Yeah, the big question that I always get is what's the difference between a bookkeeper, a controller, and a CFO? And Scott defines those great in this episode. And he also explains why every business needs a bookkeeper, a controller, and a CFO,
Yeah.
and why those should be three separate people. And look, if you're a smaller company just getting going, or you're in the mid, 5 to 7 million, or huge, it doesn't really matter. This episode is going to really give you a lot of takeaways on what to either plan for or what to maybe do now, whether you go with Scott's company Preferred CFO or you look for another fractional. I think it's just important that we're looking at our numbers on a regular, consistent basis and taking action on that data and information.
Yeah, his analogy that he gives, and I don't want to spoil it, just to explain the differences between those three roles, that it painted such a clear picture in my mind on what they do. And someone who is not super finance savvy, it's important. I work directly with finance, so it's important for me to understand, the roles of each one of these individuals. And I think Scott laid it out really nicely. So, should we just go ahead and dive in and play our conversation with Scott?
Yeah, there's one thing towards the end of the episode, he does mention a book, and I'm not going to say what book that is, but I recommend you listen to the whole episode because the last like 5 minutes is absolute gold. All right, folks, welcome back to another episode of Trades Talk. Today we're here with Scott Crawford, Preferred CFO. He's a partner there and also handles new business development and client prioritization. Scott, welcome to the show.
Thank you. Good to be here, Justin.
So, Scott, give us a little background of your background, first off, of course, but also Preferred CFO. It's a business that I'm starting to get familiar with as we talk more, but I'm really interested to talk about financials, talk about CFOs. Before we get into that, let's just give our listeners a bit of a background of who Scott is.
Perfect. So the company Preferred CFO, national in scope. We do have a few international clients, Canada and Mexico, but for the most part, national. We deliver services remotely. We think that gives us an advantage. We don't work with freelancers, so we've got a team of about 70 people, but that remote delivery allows us to match clients' needs with our team members' experience rather than simply who happens to live in the neighborhood, and hope it works out. So we think we have a higher level of deliverables and performance. Came into this space, really, my business partner is the principal behind Preferred CFO. His name is Jerry Vance. I've known him for better than 3 decades. He and I came to know each other way back when we were both working for a very wealthy investor that had made a ton of money on Wall Street and had come to Utah and was just buying and selling companies and doing joint ventures and looking for opportunities. And I was working alongside the principal, and Jerry was running the finance team. And so I was always marching down the hall to his office and essentially saying, Jerry, here's what I see as far as the value of this company and their finances. What do you see? And it was an interesting and very valuable different set of perspectives because I was looking at the financial to tell me what the company was worth. He was looking at the finances to tell him what the company was worth, what they were doing right, what they could do better, whether their finances were either incorrect at all. And so, from that early relationship, we kind of went our separate ways when the principal took all his money and moved to Florida. But Jerry Vance, our founder managing partner, his first partner 20 years ago was a fellow CFO. And they built up a company, and then that individual decided to retire, and Jerry established that momentum and established Preferred CFO and has really been in the fractional CFO space for nearly 20 years. And this came back to mind, Justin, because your reference to, boy, 20 years ago, nobody even knew this was an option to be able to outsource that skill set at the CFO level, the C-suite level on the financial side. And now it's become a lot more common, but still not nearly as common as being able to outsource your bookkeeping or outsource your HR, but still has all the same benefits.
Absolutely. And I definitely want to get into that as far as what is a fractional CFO. And a big thing that we talk about at K&D is we're landscapers. We landscape. We aren't financial professionals. We're not HR professionals. So my mindset has always been outsource the things that aren't landscape related as much as possible to people who are doing those things every day, day in and day out. Scott, like, what's your take on that type of a concept when it comes to running a business?
Oh, absolutely. We do not find many CFOs or financial people that rise to the CEO or the owners or the founder's seat. Not to say they're not capable in that area, but most of our business owners are either sales and marketing people or they're operational people. So they know how to sell a product or service, or they know how to deliver the product or the service, and they build a company around that. So even if they are CFOs, they still need to be the ones leading the orchestra, even if they can pick up every instrument in that orchestra. So this becomes one of those, didn't know that I needed it until my knowledge was expanded. What will a CFO or what will a complete financial team bring to me? Because really, I'm so busy either selling my service or deliver my service or both and overseeing those two aspects of the company. So you got to sell the service, you got to deliver the service, and you got to make sure you're profitable in what you're doing. The CFO's job is the latter.
Yes, for sure. What like Justin was saying, I have conversations about software in the similar sense that, these landscape companies want to build their own software. They want to be software developers. I'm like, no, no, no. You guys, you don't know how to do software. A, you don't understand the cost and the infrastructure and the upkeep and all that stuff. So in similar light, I can relate to that. I actually remember when Aspire hired our CFO here, and he's still here today. He's fantastic. And as far as my exposure to CFOs is contains, but we actually called him CFGO because he is so sales focused, such a sales focused CFO. And I think that is a skill and an art and a really important piece all in itself. So can you elaborate on that from your experience? Like, how important is it to have a CFO that works with their sales team?
Absolutely. And it is one of those criterias. And I know this is going to be the biggest question. And so let's just tackle it right up front. And that is, what is the difference between a bookkeeper, a controller, and a CFO? And there may be some in between positions. You might have a senior accounting manager and you might have a VP of finance. And, they're kind of in between the three primaries. What is the difference? What should each one of them bring to their company? How do you know? We don't have to tackle this all in the same paragraph, but let's start with the differences. So, your bookkeeper, every company has to have them. They're a daily transactionist. They worry about ARAP. They think in terms of cash in, cash out. Do I have cash to pay the bill? Am I going to collect the cash from this AR? Above them is going to be a controller. This is within a company. There's almost always a CPA involved. CPA is your tax advisor. They're outsourcing. Their job is to stay up with the latest in tax law, help you file your tax returns, make sure they're right. Don't pay any more taxes you need to. But within a company or outsourced, but as far as you're big enough company to completely be in-house, you're going to have a controller. Your controller is a historian. That is their job. They think in terms of accrual accounting or accrual basis accounting, but their job is to record what happened in the company. So when you look back at the financial records, they truly reflect the seasonality of your business, the profitability of your business. If you've made decisions to expand or contract or add, what impact did those decisions have? How did they play out? How long did it take for those to play out? So that when you look back as a management team at the history of your company, you have a true financial record of what happened. And when it comes time to share with an outside entity, be it an investor or potential buyer someday, that truly reflects auditable, GAAP compliant, general canon principle compliant, what the company did. CFO is a forecaster. And the best analogy I had came from a business leader in Texas years ago. And he says, I explain the differences between a controller and a CFO this way. The controller is the person standing at the back of the ship, radioing up to the bridge, to the captain, that everything behind the boat looks great. Carry on. Whereas the CFO is standing on the bridge next to the captain, helping he or she navigate around obstacles and choose the best possible financial path into the future. And that's the CFO's job. CFO is forward facing in their decisions, their perspective. A controller is rearward facing. There are differences in those two thought processes. Some controllers are just on their way to becoming a CFO because they already think along those terms, but some never make that leap. Some, we've seen all these different brain models, brain studies, and personality studies. There are some people that think they're going to be a CFO someday and they never will be because they can never change the way they think about things. So it's a concept because we have employees, we have full-time team members that we know how they think, we see their results, but it's a difficult concept to communicate. That is the first example, rearward facing, forward facing, back of the boat, front of the boat. But here's the other one. And Maggie, it came to when you were asking about supporting the sales team. A controller deals in data, a CFO deals in information. And ponder those two differences. What's the difference between data and information? So data is facts and figures, and that's what a historical document is going to show. Information is actionable. It delivers or should deliver to a management team the data or the information, but in a form that communicates what has happened as a result of prior decisions or allows you to choose going forward. We say often, if your CFO's answer to every question is no, if they're a CFO, they're probably a controller rather than a CFO. So when you're dealing with the finance team and in most, or with the sales team, in most companies, the sales team and the finance team or the CFO are bitter enemies because the sales team always wants to say, hey, what if we did this? If we tried this new approach, could we close more deals? Could we bring in new customers, bring in more leads? And so they're always looking to expand the budget. And the CFO's like, no, you haven't proven anything to me yet. So you're asking for more money, but you haven't produced a return on investment. And I'm not sure you can produce a return on investment. So the answer is no. That's not a good CFO. Good CFO would go, well, let's see what it would take to make this project work. That's the way they should approach do you think we can do this? Whether that inquiry is coming from the sales team or whether it's coming from the CEO or the other C-suite members. Data versus information.
Got it. Wow. That's a great way to think about it. And that whole data versus information question, when you first asked that, I was stumped. I was like, I don't know. I had no idea. But the idea of data being factual content that you can look back on, and then information being more of this formation of ideas that may lead to a result. So much more of a leading indicator and kind of a leading look into the future with the information. Is that correct?
Yeah. And it shows up in a regular basis. So, there's a number, and we can get into this if you'd like, Justin and Maggie, but there's a number of essential documents or tools that we believe the finance team, CFO and controller, should provide to the company. One of those is just your monthly report that it's got to be accurate. It's got to be closed on time. If you're not closing the prior month by the 10th, if it takes the 15th or the 20th, you've lost a month to respond. So you're never making current decisions. But, if the head of your finance team comes to the monthly meeting or walks into the CEO's office on the expected delivery date of last month's document close and drops the report on the desk and says, here's the report for last month, see you next month. That's data. That's a controller. If the head of the finance team walks in and says, look, here's the report for last month, happy to drill down anywhere you want. But that meeting we had 3 months back where we decided to make this little change? It has been amazingly effective. And you can see it right here in the numbers. That issue we had with the profitability of this one division had been turned around. But yet there's something else that's beginning to show a trend that I don't think we expected to have come out of that. And again, I'll be happy to drill down with you when you want, but there's some things I think you should be paying attention to on the finance side. That's my report as the CFO. And that's information versus data. And that's the role that a good CFO should provide. The CEO doesn't have time to become the CFO, even if they have that history or that skill set. They're too busy running all other aspects of the company. You need somebody else to be able to be the watchdog or the lookout for what's going right and what's going wrong.
Yeah, Scott, you mentioned two big things there. First is the date, closing the books by the 10th. And we just had a big conversation about this last month in my CEO Vistage group because the other speaker who spoke, he asked everyone, we need to close by the 10th. Who's closing by the 10th? And no one put their hand up. We're usually around the 10th, maybe the 12th, at the latest the 15th. And we've worked hard to get there. Our current controller, she's amazing and what she's been able to do. But I would say the vast majority of my peers that I know of, it takes them 30 plus days to close. It's rare that they're closing the same that next month. And so to your point, they're at least 30 days behind in their data and then maybe even further in their trends and information. How much of an advantage is it to a business that is able to close on the 10th and then to have a discussion around those results and trends? Like what type of advantage are people looking at and why should maybe they invest some money and resources to get that close date earlier?
Great questions. And I'm going to touch just a little bit on some of the tools that we believe are the financial documents we believe a financial team should provide because
Perfect.
they come to this implementation. How do you have this discussion with your team? But a lot of companies, many companies are seasonal. Landscape, I can't think of many businesses that are more seasonal than that.
Yeah.
So what happens if you've got a seasonal business? So let's say you got a 6-month strong season. That's prime. Maybe it's generous, maybe it's 4, maybe it's 5, maybe it's 7, but let's call it 6 months. So if you're not closing by the 10th of the month, you're closing a month later, you're not responsive. You don't have a 6-month season. You have a 3-month season because you're working a month after the results you're trying to fix are gone behind you. So you don't have the ability to manage and make adjustments during the season where you can be most effective at producing results. We believe that every company should have an annual budget. So an annual budget, just some of its characteristics, it's obviously set before the 12-month period begins, whether you're fiscal or calendar. But the big characteristic is it's a stake in the ground. Your budget, if done properly, should not change during the 12-month period. And so I talk to a lot of companies that go, yeah, we've got a budget. Well, do you change it during the year? Yeah, we have to change it at about each quarter or at the midway point. Well, then you don't have a budget, you have a forecast. And the reason why the budget should be static in most companies is because you want to assign resources that your different stakeholders, it could be your division heads, it could be different divisions, it could be different officers, your sales team, your operations team. You want to give them their budget for the year and set expectations about what they're going to produce with that budget. And then you let them go do their job. Harry Ford says, I don't know if I remember the quote exactly, but was one of the fathers of automation, says, if you get everyone together on the same page, then success takes care of itself. So, and that's the purpose of the budget, is to put everyone together. So you establish this budget, and from an implementation standpoint, the CFO is generally responsible for this, but it's a C-suite function. But the CFO can solicit all the stakeholders in the company and say, what do you want for your budget for next year? Create a straw man budget, and then come into the annual meeting with your stakeholders and say, I've created this budget from all of your individual budgets. We're going to have to fine tune it because we don't have the kind of resources each of you are asking for. But you finish that budget meeting with everyone essentially putting their hand in the middle and saying, hi, we're on the same page together. And then you go do your jobs. But each month, let's say by the 10th, you should have a budget to actual report. That's generally provided by a controller because it's historical, but it is a report where you bring your management team together. These meetings can be quick. Once you get into a rhythm, 30 minutes, 45 minutes, an hour max each month, and you compare how each department, each stakeholder performed in the prior month and year to date against the original budget. And it's not just to find fault, it is to convey opportunities. So if some division started doing something and they're producing better than expected results, what did they do? And how can they help the departments or the stakeholders that are falling behind? So this is how you have continuous improvement. Set an annual budget and then have a monthly meeting with all those same budget stakeholders to show how they performed last month, how they perform year to date against the budget, and what their contribution is to the overall goal of the company. because obviously you're looking at the company's performance against budget each month as well. There is a follow-up to that in a more advanced financial team, and that is a rolling 12-month forecast. So it's similar to a budget, but it's always 12 months in the future. It's always picking up a new month every month. And so when you have that monthly meeting with your team after you've gone through the performance, the question is, what are you seeing in your area of responsibility, or more broadly than that, that you believe will impact you, your responsibilities in the company and the company at large, that we need to be aware of? Are we being impacted by a new competitor? Is there a new product out there that would make us more efficient? Are interest rates impacting us? What are we seeing as far as if you're doing landscape new builds, are we seeing more of a shift to multifamily and less single family? And so you have your group share that information, and it's reflected in a rolling 12-month forecast. The CFO is always using the latest, greatest information to give the management team visibility, detailed visibility month by month by month for the next 12 months. And that monthly visibility is important when you have a seasonal business.
I think what you're saying is extremely important, especially from the high level management side of things. I'm going to challenge it a little bit because part of the message that we share, and I want your thoughts on this, is you need to be reviewing, especially like you're not above the line, above the gross margin line, financials daily. Even weekly is amazing, but daily would be better so that you can make shifts to individual projects, whether you're over cost here, if you have the wrong labor out of here, and et cetera. So is it fair to say what you're talking about is more big picture, step back, think like bigger impacts to your budget and your overall financials? Whereas like how often would you recommend looking at the day-to-day direct cost drivers?
Yeah, so a great question, Maggie. My reference really was from a month-to-month leadership, and it really based around these tools, the budget, the actual budget report, and rolling 12-month forecast. But if we go to this bigger question that was asked in the beginning, and that was, when does someone need a full-time CFO? When does a fractional CFO work? When a company gets to be the size that they need and benefit by 40 to 50 hours a week of CFO time, obviously they need an in-house solution. Because if you're paying for a full-time solution and it's outsourced, unless there's a reason for doing that because you have access to a person of the skill set you need, or you believe it's a bridge or a temporary position, you're going to pay more per hour for outsourced than an internal employee. If your company is so big and you have so much going on, and you're going to benefit by having somebody looking at every one of those metrics every day and reporting opportunities and problems to the CEO, that's when it's a day-to-day involvement. Your CFO should be looking at those numbers every single day if your company is that size and can warrant that kind of an expense. I don't have permission to use his name, but I know of a company, an individual that built an extremely successful national company. And I heard him speak at a big event, whole bunch of, about 300 business leaders there, about 400 business leaders there. And the interviewer said, who was the most successful person besides yourself at helping you build this big company? And he's building it up. He sold it once before and then bought it back and is working towards $1 billion valuation. And he said, my CFO. He said, but I got to tell you, I hated my CFO. Well, why did you hate your CFO? He said, because every day he met me at my office door and said, we're going bankrupt. If you don't stop doing this, or if you don't start doing this, we're going to go bankrupt. The interviewer said, did you ever go bankrupt? And he says, no, because my CFO kept telling me what I needed to do to not go bankrupt. That he referenced it was every day, but whether it was every day, every week, every other day, those are the kind of adjustments that a really well-run company are being made on a regular basis. Not the CEO being the CFO, but the CFO saying, here's what you need to be aware of. Here's what you may want to look at and change.
Yeah. That was actually leading me to my next question, but I think Justin has a comment here before we get into it.
Oh, I was just going to go back to the whole idea of the annual budget and then the monthly review. And it's something I would say we did a okay job on up until about 2 years ago when our current controller came on board, and she created this month-end report that she would prepare. And it's a nice PowerPoint, and it provides all of those data points, the budgeted revenue, the actual revenue, all the way down to net profit and then a lot of other drivers from sales and other things that we review. But what we did is before 2021, 22, I always did the budget. I did the budget and it was like this thing that I did. It was really, I was pretty accurate, but I knew that to grow to where we want to be, I needed to delegate the creation of the budget to the VPs and the department leaders. And so that's what we've done over the last 2 years. And the way that they have gotten to be successful and where they're going is by reviewing the data and information that has been completed. So, hey, what did you budget for May? And then what did we do for May? And what's the difference and why? Right. So, when we were able to do that, every month they're learning more and more about that seasonality, but it takes like a full 2 years, I think. We're into the second half of the second year for them and for new people to understand how a budget is created and then what are the impacts of it. Seasonality. Yeah, that job that was supposed to start in June and it didn't start till July and that hit. And that's okay. Like it's okay to miss your budget, right? And this is a question, Scott, I want to get to you, but like it's more important that you understand why you missed the budget than just the fact you missed it. So we've found that our team is learning much quicker that we're doing these monthly reviews. What's your take on that? The whole idea of missing a budget. It's not the end of the world, right? It's just you got to know what happened.
Yeah, I mean, you can't focus on 1 month out of 12, even in a 12-month budget. So you're looking for trends. So yes, things get missed, but that budget is important because it lets everyone know how they fit into the entire company. So you may have one department, one division that missed their budget 1 month or missed their budget for 2 months. And they can say, well, no big deal because I'll make up for it later. But how does that impact other parts of the company? Are you going to have to raise some money? Do you have the cash to be able to bridge the other obligations, your fixed expenses? Because one division is going to be 60 days behind in the revenue they're supposed to be generating. So this whole part of knowing where everybody fits together in continuous improvement is part of that budgeting process and part of the monthly budget to annual, or sorry, the budget to actual report that you just bring them together and everyone knows how they're performing. You share ideas that have caused somebody to be more successful than another and to be able to elevate everybody, all departments at the same time.
Yeah, budget and misses, like, obviously, we want to no, don't wanna dwell on them for too long. We definitely wanna learn from them and everything you guys are saying. What numbers or trends or specific things do you see where a big significant change does need to happen, whether it be a headcount reduction or some sort of big leadership change? What are some leading indicators that you see that can lead to significant change within an organization?
Meg, are you referencing when you might change a budget versus being able to stick with a fixed budget?
I mean, that
Okay.
might be one example. I think an example Justin's talked about here in the past is just like when cash flow gets really tight, but certain times of year, cash flow does get tight. So when is it time to panic?
Yeah. This concept of having a static budget that's put in place before the 12-month period begins and not changing it during the year, that is sometimes difficult for small and mid-sized business owners to come to grips with because they like a little bit more flexibility in how they manage their team and how they allocate resources. They want to be more spontaneous. We look back at COVID-19, that was a black swan event. Everybody's budget had to change. And it was interesting, our clients that we had coming into COVID, of course, the leadership that we provided to them at the CFO level changed because in many cases, depending on how impacted they were by COVID, and some were not impacted at all. Some of them actually saw windfalls. But, if you were in a business, hospitality or travel that was completely shut down, the immediate goal became, how do I cut expenses? How do I cut overhead? And you needed to have some visibility as to how deep you needed to cut. Your first payroll cut needs to be the only payroll cut. Or if it can't be
Yeah.
the only one, it needs to be the deepest one. Otherwise, you just establish a pattern of fear because everyone's waiting for the next fall. But when black swan events occur is when you have to go back in and do that. You may have a black swan event in your industry. Maybe you're a gypsum importer and you're based in Baltimore, Maryland, and the bridge that allows access to your port got knocked down and it'll be 6 months before you get any supply lane in and chain in. That's a black swan event. But for the most part, you want to be able to allocate resources and let people go do their jobs. So, yeah, what is the right time to readjust it? It's when the completely unexpected comes. Part of that forecasting process, you have a rolling 12-month forecast. It's not just forecasting your revenue and your expenses, but it's forecasting your balance sheet, which will tell you your ability to liquidate resources, how liquid they are, your assets, and also forecasting your cash for all 12 months. So what really would cause you to revamp your budget is if last month's report shows you that because of a much less than expected revenue generation, you're going to run out of cash or your cash supplies are going to be depleted below your planned reserves. That's the time when you really have to start making some changes. You cannot run out of cash, or you've got to find a way to augment that. We asked a question in the seminars I conduct, when do most companies run out of cash? And rightfully so, most CEOs respond to when they're growing. So everything's going great. You just don't think you're going to run out of cash. If you're shrinking, you tend to watch cash a little bit more closely. So I made a presentation at a group to a bunch of business leaders in Arizona. They're having a great economy right now. And their great challenge was we have cash challenges. So I went back to my CFO team and I said, specifically, how do I address this for successful growing companies? Their answer was really simple: forecast. How do you avoid cash crunches? You forecast, because a loan is easier to get when you don't need it. And credit is less costly when you don't need it, when you're doing well. So if you know 3 months or 60 days or 9 months before you need a cash injection because of your growth or for whatever need, then you can arrange it at its most favorable terms and have it waiting when you need it. And it becomes just part of your management's process rather than a panic mode.
And Scott, would you recommend that facility being a line of credit as kind of that backup cash facility?
Most business owners prefer credit versus equity investments because they don't want to give up that equity. So if you're able to qualify for credit and carry the debt burden, most CEOs that I know and deal with, that's their first choice.
Yeah, that's been our focus since I took over the business in 2015 was how, always trying to get that line of credit as high as possible because what you just said, and I don't want to skip over this advice you just gave, which is the best time to get a loan or get that line of credit is when you don't need it. And that is advice I was given in 2015 when I was just getting this business taken over from my parents. And from that point forward, we've pushed that line of credit as high as possible. And one of the things that the banks always look at is, well, what is your current position today? And if you're in a strong position today, but the next 3 months you're going to hit that seasonal ramp up, which for us is always spring, and your cash is going to be depleted, you should have a credit line increase. And we've moved our dates around, but we try to have a credit line increase when we are the most cash heavy. And there's just strategy to that. And your credit line shouldn't be used as a continuous loan on multiple years. It's really a facility to be used for a maybe 3 month, maybe 6 month period. So what would your recommendation be for folks out there who don't have a line of credit? What's their first step in going about getting something like that?
Well, you got to make sure your financials are correct. Obviously, you can't go into a bank and say, or whatever credit union, lending institution, whatever, and say, hey, I want a loan. Well, give me your documentation. I worked it up in the lobby on this napkin. I hope it'll work.
Yeah.
So, yeah, you want to make sure your finances are correct. It's helpful to have somebody with you if you have a CFO, whether they're employee or whether they're fractional, that can speak to the financial side of the company. It gives lenders great confidence to know that they've got a set of eyes that know what they're looking for within that company and that the documents that are being provided are indeed GAAP compliant. They're accurate. They're truthful. The bank can make good decisions based upon that.
You've mentioned GAAP a few times. Can you explain what that is for people who aren't financially
General
proficient?
accounting principle.
Okay.
So in the United States, the guidelines that dictate proper accounting.
I want to actually ask you a little bit about Preferred CFO, the company that you're a partner at. At what size, how small of a business do you work with? Because I know there's some businesses that I know of who are doing between, 500,000 and 1.5 million in revenue, and they really have no grip on their books and their financials. They have QuickBooks, right? Which everyone has these days, or some kind of app that does their numbers, but their general ledger's a mess and their P&L is not really accurate.
Uh,
And what size do you guys get involved with? And I
I'm
guess,
gonna
yeah,
confirm that because I feel like the anomaly is actually knowing your numbers, having a good grip on your financials when you're that size. So, like, if you are in that boat and you don't have the best grip on your financials, you are the norm, and it's time to break out of the norm.
And that's a great question. And I'm glad we've come into this now because I know it was kind of approached at the beginning. What's the right fit and size and when can you get an ROI? And this is where the rubber meets the road. So we truly believe that every company needs the services of a bookkeeper, daily transactionist, controller, historian, and a CFO, a forecaster. We have companies that come into us that are very well funded. Most of them are tech or SaaS, a lot of money being put into that business channel today. And they'll ask us for that. Look, we need a part-time bookkeeper. We need a part-time controller. We need a part-time CFO. We got the money to pay for it all, and we'll provide that. And ultimately, as they grow, we think that our approach is the best possible deliverables or results at the best possible price. The best possible price is finding that right mix between in-house and outsourced resources. So as the company grows, let's take a good SaaS company and we're providing part-time of each of those bookkeeper, controller, CFO. When the demand for their bookkeeper reaches 40 or 50 hours a week, we're going to be the ones that tell them as their CFO, it's time to take this in-house. That's going to give you the best ROI. We'll repeat that at controller when they need 40 or 50 hours a week of a controller. And we'll repeat that at CFO. If they grow to that point where they need 40 or 50 hours a week of CFO and they can get a return on investment for each of those hours, we'll help them find our replacement. We'll train our replacement. We'll hand off and they'll go up forward with an in-house chief financial officer. So our clients, the reality is if you've got a lot of money behind you, you can have those resources from day one. But the reality is that most of our clients come to us at about $5 million, $6 million in revenue. It depends on their profitability. A tech or a really profitable SaaS company is probably half that. But that's when they should be able to get a return on investment from a fractional CFO. And maybe it's a fractional CFO and a fractional controller, each one doing their job for the right amount of hours. And then, once they grow to be 80 or $100 million, they should probably be finding a return on investment from a full-time CFO and a full-time in-house controller. That controller having been put in place full-time somewhere between that 5 and 80 or 5 and 100. So, and we've got some clients that are much bigger than that you still use us on a fractional basis, and they just haven't been able to say, hey, I don't see a reason to go full-time. You're giving us everything we need. But there's a lot of history there and a lot of momentum, and it's always keeping everything up to date and fine-tuned. One
yeah,
advantage to the fractional, and it's not just in the CFO, it's fractional anything. Your fractional IT, your fractional HR. Most companies are better served to have a part-time A player than a full-time B or C player.
yep.
And we talked earlier about taking a controller. They need the CFO. We're to the size now, we need a CFO. So we're going to promote our controller and call him our CFO, or we'll hire a controller and call him our CFO. But they'd never gain that forward-looking mindset. They don't have anybody that thinks in those terms. They just check the box for the CFO. If you can have access to a part-time A player, especially if it's the skill set and level of the company you want to grow into, you're so much better served than having a full-time B or C player. Because the differences between an A player and a C player are not 10 or 20%. They're 5 or 10 times the efficiency at being able to know, I've seen this 20 times. I know what the solutions are. There's 3 possible solutions. Let's look at each possible outcome and we'll make the best choice and move forward. And that becomes very efficient rather than spending 6 months trying to figure out what the solution might be as a C player.
Those are such great points, Scott. And I completely agree with someone who's the CEO of a $20 million business. I can relate to this. I'll also add, as you're growing from 5 million to 20 million to what I would assume 100 million, I can't really speak on that, but as you're going from 5 to 10, 10 to 20, your needs change dramatically year to year. And it's really, really hard if you have a certain person in the controller seat that is not only are they going to be able to switch from rear facing to forward facing, that's hard enough, but then they're going to have to grow and be able to have the capabilities of managing now a 2 to 4 times bigger business. The idea that that person's going to work out as that scales is it's really rare, I think. And what you end up having is you have turnover when you hit these different milestones and these different levels of business. With a fractional, what we've found is you eliminate that turnover because you have a partner who is going to continue to be with you no matter what happens internally from an employee standpoint. And when we're talking about financials and we're talking about some other important areas of your business, and I would say financials is number one, how important is it that you have someone who isn't an employee in today's world, who isn't able to get poached and is backed by an entire team? I mean, I'm sure that's got to be one of your guys' key selling points, but for us, it is worth so much money because you don't have that possibility of that person walking out the door one day.
Yeah. There's this issue about the longer you can postpone that hiring decision, the better person you'll get in that position. So obviously it's CFO. If you think your company, your goals are, 5 years from now, you want to be $100 million. You're 10 today. So that's obviously very aggressive growth. The CFO you'd hire today would be one. It's really going to be a controller at 10 million because you can't afford the CFO salary at that. But let's suppose you hired a CFO at 30 million, but you're going to 100. The CFO you're going to hire at $30 million is a $30 million CFO. They're not the $100 million CFO. They're not the $250 million CFO. So the longer you can postpone that commitment and the liabilities that come with a hire, the better individual you're going to get. So in the meantime, you're going to utilize an A team on a part-time basis until you get to your 18 full-time basis. It is not uncommon, but a couple of years ago, we hired 2 CFOs and their CFOs brought their former full-time employers to us as clients. So at the end of the year, I was chatting with both of them and I said, so tell me how many hours you're putting in to provide the same services to your former full-time employer. And one of them said 50%. The other one said 40%. I'm doing the same work I was doing before. I'm doing it in less than half the time, 40% of my time. And I asked them both, why is that the case? And Justin, you reminded me of this in the question you asked. And it's because, when you got full-time people and they're used to working with each other, there's politics involved. And so it's not uncommon to have the head of sales be approaching the CFO and say, let's go for drinks or let's go out this weekend because what I want to do is I want to influence you to get more budget. I want to have more access to resources because you're the CFO. You should be able to give me some space here. And you don't have any of that when you're really outsourced. I mean, people can ask, but they're just not those water cooler kind of discussions. They're very focused on what needs to be done. And what needs to be done as a CFO is all financial and it's all leadership and it's all reporting to the C-suite.
I think we look at the financial side of a business as just, it's like transactional. It's something we kind of have to do. The money's made in the field or the money's made in sales or what have you. We have tried to look at our financial team as more and more of a profit center. And what's your take on that? When we talk about, getting better terms with vendors and all these things that your financial team can do to actually increase your profitability, Scott, what are some of those things that we can do to start looking at our financial team as a profit center rather than a cost center?
Wow, great question. It would not have come up in my normal thought process, but a CFO should be a profit center. And I'll tell you how they do that. A controller, not so much, and certainly a bookkeeper, because they might have opportunities where they're managing the cash well enough, they can take advantage of some early pay discounts and, pay 30 days early and get a 2% discount. That goes right to the bottom line. Controller's a historian. They don't have much opportunity there. But in addition to the financial leadership a CFO provides on a daily basis, they should be able to provide analyticals. I asked the question in these seminars I conduct, how much money does Costco make on rotisserie chicken? $4.99. Been $4.99 for more than 20 years. Except for in 2008, they bumped it by $1 to $5.99 in the US. And they pretty much quickly brought that back down. There's data out there. Costco doesn't always confirm it right now. It's just kind of accepted. They lose about $100 million a year by selling rotisserie chicken at $4.99. And the question is that a mistake? Do they not know that? Does Costco, are they not smart enough to know that? They absolutely know that, but they also know how much money they make because they sell rotisserie chicken $4.99. So that is an analytic called contribution margin or contribution margin analysis. And it can then be divided down into product line analysis and customer analysis, or it might be division if you have a company that provides multiple services and you want to know which was most profitable. And it's the analytics that a CFO does. So that is, if there is going to be a trade secret, that is knowing how the sausage is made. And a CFO should be able to do that. I gave a presentation couple of months back to a group in Vistage Group in Spokane, Washington. And then I had a chance to talk to one of the CEOs, big company CEO, about 6 weeks later. And he said, I went back to my team, they have a CFO, and he says, I want you to do this thing I just learned about, which is product line analysis. And he says, we were discontinuing a couple of our products, our services. Our CFO came back and said, we didn't know this. These are our most profitable products. And the reason why they didn't know that, because they were collecting a fee for these one time per year. And then they just delivered services every month thereafter, but they were only transacting with the client once per year to do this. And so there was no visibility of activity, but yet the analytics were it was their most profitable product. So it very quickly changed the direction they were going as a company to not discontinue products they thought were not profitable and was just gut instinct, and to be able to refocus on their more profitable products.
It's so funny because I guarantee Costco, every time I go to Costco and I ring in my rotisserie chicken, because I do get those quite often, I'm going to see how many other products that I get with it. And I know that Costco's analytics team is looking, okay, who bought a rotisserie chicken and how much additional spend did they spend while buying it? And for the landscapers out there, whatever, commercial cleaners, janitorial, whatever you're doing out there in the trades, I think this is why it's so important to look at margin by service completion. And while mowing, we all know mowing has the lowest margin out there, typically has the lowest margin out there. How many mowing clients also pay for you to do their rounds of fertilization, their weed control, all that, which ultimately ends up in your high margin. So the full suite of products is ideal. And I encourage landscape companies out there. I've actually talked about this during implementations and different things, that if you have a client that is just doing mowing with you, no other services, go ahead and give that client to somebody else. You're not missing out on it. So
there's a book. Here's the second little secret that you may take out of this. So there's a book, not a brand new book, been around for a while, very well tried and tested, entitled Islands of Profit in a Sea of Red Ink: Why 40% of your business is unprofitable and how to fix it.
love it.
Islands of
Wow.
Profit in a Sea of Red Ink: Why 40% of your business is unprofitable and how to fix it. So that book was first introduced to me a number of years ago, and I took it back to my team and I said, is this true? 40% of a business's services or products are not profitable. Is it true? How do you know? And if it is, how do you fix it? And that's what I referenced in this contribution margin analysis and product line analysis and customer analysis. We call that internally our secret sauce. And it's how a CFO produces a return on investment. They produce for a company profit that is far beyond what the CFO is being paid. And the CFO salaries are generally pretty lofty. So if somebody wants to try and DIY it, grab that book
Yeah.
and see if it doesn't
Yeah.
give you any clues as to what your team should be providing to you for improvement in profit and identification of unprofitable activities.
I appreciate it. That's a great recommendation. And we got blessed today with 2 trade secrets. So I appreciate that, Scott, as well as all the other wisdom you've shared with us today. If our listeners want to reach out to you or partner with you or hire you to do a seminar or whatnot, what's the best way for people to reach out to you?
Just directly at, I can give my email address and cell phone number, and it's Scott C, first name, and then first initial of last name, Scott C at preferredcfo.com. And cell phone number is 801.
Awesome. We'll put that in the notes for the episode too. But thank you, Scott, for everything you shared today. I know our listeners will get a ton out of it. And if you're ever in the lookout for a CFO or trying to understand if you need to hire one, definitely reach out to Scott.
Just to wrap that up, it is a function of fit. There's got to be a return on investment. So we don't want to take on a client if the outcome is not what we both want to see come out of it. And that is a much better, more robust, more profitable, more strategic company.
I love it. And so many of the people listening to this podcast are growth minded and they're growing businesses. So whether you're just getting off the ground and you haven't seen your first dollar revenue or you're $100 million business, hopefully this episode brings a lot of info to you, but it's never too early or too late to reach out and get some help on your financials. So hope everyone had a great time listening. Scott, thank you so much.
A pleasure. Justin, thank you. Maggie, thank you very much.